Thank you all very much. It's a pleasure to be here today. We're going to talk about the economy. We're going to talk about a few different things. We're going to talk about the outlook for autos, and we'll talk about a few different things you're probably worried about. I really want to start by discussing sentiment, global sentiment. It's really, really important because it's a really good leading indicator of growth. This graph has three lines on it. They're purchasing manager indices. Since y'all are in manufacturing or touch it in some way, I'm hoping that this is not something I have to spend a lot of time explaining. But it's basically, there are purchasing managers, manufacturing companies, they buy raw materials. And you ask them month after month, are you buying more or are you buying less? If the number's below 50, it means they're buying less. If you're below 50 for a number of consecutive months, then that's a really bad sign. In the US, manufacturing is about 13% of GDP. But if you're below 50 for 3 consecutive months, or actually if you're below 48.5 for 3 consecutive months, you would have likely seen a recession in the last 20 years, because you did in 2001 and 2008. I'll talk about that in a minute. For China, we've seen in 15 of the last 16 months, their manufacturing's contracted. Now, in the US, if you have 3 months in a row below 48.5, we're likely to be or go into a recession. Our economy, manufacturing is 13%. In China, it's 31%. Now, just yesterday, Lagarde, the head of the IMF, did an interview with Bloomberg, and she said that this year they expect Chinese GDP to be 6.5%. I would tell you that that number is pure fiction. For the last 15 of 16 months, Chinese manufacturing has been contracting. That economy is in recession. Now, there was a bump in the US that happened just in March, and it was the first time that US manufacturing expanded since August of 2015. And for those of you who might say your manufacturing in Europe are weak, it was also the first time since June of last year that US manufacturing expanded month over month at a better clip than Europe. So if you think Europe's in trouble, I have some bad news. But I don't want to spend too much time on this because we're going to get to the good news, the bad news, and the very bad news in just a couple minutes, right? Don't worry, the very bad news section is really short. It's just one slide. The good news section is only 4. So the growth is really slowing. These are the IMF numbers on the left and Prestige numbers on the right. IMF forecasts from January were revised lower to 3.4% for this year for growth, 3.6% for next year. Those are going to be revised lower this month. Lagarde said that just yesterday. Additionally, 3.1%, which was the most recent reported growth rate for 2015, was the slowest global growth rate since the Great Recession. If you had seen also this morning's IMF report, you'd see that some of the cash and capital inflows in and out of emerging markets were at the worst level in decades. So there is some real systemic global problems going on right now, and real risks to the global economy right now. In the US economy, there are also some pretty big risks. Our forecast for global growth is 2.9 for this year and 2.6 for next year. This year, 1.2, next year, minus 0.5. We believe that by the end of this year or next year, we're going to be in a recession in the United States. Now, some data actually shows that we're already in it, and we'll talk about that in a minute. There already is an oil and gas recession, and there essentially is an industrial and manufacturing recession right now. This industry has been blissfully isolated from that for many different reasons, but it's going on right now. As for the Fed, I know you were just at lunch. If anyone still had a fork, you could stick it in the Fed because I think they're done, right? Janet Yellen gave a speech last week to the Economics Club of New York. She picks the titles of her own speeches, no surprise. And it wasn't titled The Outlook and Monetary Policy. It was titled The Outlook, Uncertainty and Monetary Policy. They're probably done. So let's start with some good news, right? And maybe I should start this presentation this way instead of kind of, getting the cold water out too soon. But the US ISM manufacturing and non-manufacturing indices are two critical PMIs. They're forward-leading economic indicators. The ISM manufacturing is in blue, non-manufacturing is in red, and you can see that that break-even of 50, services, which are that red line, are okay, and they rebounded a little bit in March after falling for a number of months. And the blue line, which is manufacturing, after having not expanded since August of last year, finally expanded in March. And the question is March the trend or the exception? I'm very concerned. We'll talk about the bad news in a minute, so I don't want to talk about that just yet. But this having been below 50 for a number of months is not a good sign. The fact that services slowed is not a good sign. Some other things that look good are jobs. If you look at the green bars, these are the number of jobs added month over month to the right axis, and you'll see that we've had a longer run than the last cycle. Things look pretty good. You're adding quite a few jobs. And the blue line, which is the unemployment rate, it's been falling. It bumped up a little bit for March, but at 5%, it's pretty low. We're pretty close to full employment. Jobs look pretty good. Auto sales, last year around 17.4 million. Hey, auto sales are rocking. But I'm a bit concerned, and we'll talk about this, I don't want to get to the bad news too early, that also subprime sales are boosting some of the OE side, and if credit were to tighten up, then you could see a reduction in OE sales. And by the way, we did a little survey of AASA members before the conference, and there was actually an expectation for the next 2 years, you would see OE sales be weaker than they were in 2015. Consumer confidence still looks pretty good. It's fallen back for a few months now, but it's generally pretty good and not near recession levels, which is good. So now we've heard the 4 slides about the good news. The bad news is like 20 slides. So let's talk about these. We'll go through them quickly. I know this is not the time of day when there's going to be an open bar afterwards, but we can dream. So the bad news. In the fourth quarter of 2015, US GDP was revised up to 1.4% from 1.0. The bad news is that the Fed has something called GDP Now. The Atlanta Fed puts it together, and it keeps a running estimate of what the current quarter's GDP is likely to be. 0.4 is the current running estimate of Q1 GDP. The second thing I'd say is if you look, you'll see a little tiny red box highlighted there. That's the recession in investment that's been going on in the last 2 quarters. Seeing 2 consecutive quarters of contractions in investment. Not a good sign. Also not a good sign is that corporate profits are in recession right now. So that's bad. Something that looks kind of good is total retail sales. It's decelerated in recent quarters, but you'll notice it's positive, it's okay. It's kind of close to recession 01 levels, but it's positive. If we strip out autos, we find that US retail sales, excluding autos, this is retail. This is what everybody tells you is growing really strong right now. All those people with new jobs, consumers, it's strong, it's strong, it's strong. Retail sales, excluding autos, have been, in the last few quarters, lower than any time during the 01 recession on a growth basis, and the year-over-year rates have been lower than during the first half of the Great Recession. So retail not looking so hot. On a monthly basis, there were some recent pops on a year-over-year basis, but you can see very clearly that, versus the quarterly, which is this graph, the month-over-month numbers very clearly show that we've been in a danger zone for a number of months. And this is retail. Housing starts, but maybe you've heard in the press, housing starts are great. Housing starts are up. They're up. But if you look at this chart, which goes back to the 1950s, what you'll see is that the current level of housing starts is closer to the trough of every business cycle except 01. In other words, housing starts are still at recession levels. This also has implications for autos. Why, you might ask? Well, in 2001, there was no recession in housing starts because of subprime. What had happened? You pulled forward your sales. There's a huge risk that in autos, because there's been an expansion of subprime sales, that you're actually going to pull forward sales that might take a long time to replace. Doesn't mean subprime crashes. Doesn't mean any of the securitized subprime loans blow up. They don't need to blow up. They just need to stop. If you reduce the issuances, you end up with this kind of mess, where it takes you years to get back to that 17.4 we had last year. As for the ISM Manufacturing Index, the last 3 times it was below 48.5 were, for 3 consecutive months, were in the 08 recession, the 01 recession, and the immediate 3 months preceding the 01 recession. Most recently, 3 consecutive months were November, December of 15, and January 2016. This is going on right now. My book, Recession Proof, came out in February. Started writing it in August. Also a leading indicator, maybe. Year-over-year industrial production, if that's not good enough for you, you go, that's just since 2000, that's the 90s, whatever. That's not far enough back in time. This is industrial production. And what's happened is for the last 4 months, it's been negative year over year for 4 consecutive months. Now this graph only goes back to the 70s. I wish I had one that goes back to 1952, because the last time industrial production was negative year over year for 4 consecutive months, and we were not in a recession, was 1952. This is the real deal, guys. And meanwhile, what's the Fed doing? They're still expecting interest rates to go up. So if you're in corporate strategy, you're probably freaked out because the Fed's current mean end of 2018 forecast for interest rates is 2.94%. The end of 2017, 2.04%. And the mean estimate for the end of this year, based on the Fed's own members, 1.02. This forecast is only 3 weeks old. Now, I'm going to Vegas later today. I heard you guys did some fake gambling, but I will bet anyone here that none of these numbers ever happen.